So let's discuss for a moment. When you were last before the committee in June, you noted that the U.S. banking system has been a source of strength during the pandemic. The Fed's monetary policy report released on February 19 reaffirmed this point, stating that institutions at the core of the financial services system remain resilient. Do you continue to believe that banks are a source of strength? And will you elaborate both on what that means for the economy and for banks' abilities to lend, yes, absorb losses potentially too, and provide liquidity in distressed markets?
Yeah, so we've, we spent, and the bank spent 10 years in a strengthening process, higher capital, better risk management, higher liquidity, all of those things. And then we received a world historical sized shock in the form of the pandemic. And I think, essentially close to a year into it, almost exactly a year into it, we see so far, what we see is that our banks have held up quite well, and their capital, the big banks' capital, has actually increased over the course of the last year, while they've also taken $100 billion plus worth of reserves against losses. And so they are able to keep lending. They're not a source of weakness. At the beginning of the pandemic, they were very important because they did absorb that huge flow of deposits, and they made all of those loans as companies pulled down their lines of credit. Now, those were paid back early on, but at the very beginning, when it mattered a lot, they were a source of strength. So I think all of that is right. We've always got to continue to be vigilant on those things, but a first draft of history is that the banks are strong. And I would say the same for small and medium-sized banks as well, have generally held up well. There are going to be issues, and as we come out of this, there are going to be businesses that fail, and there will be losses, but it's quite different, a very, very different situation than we had after the global financial crisis.
Absolutely. And Mr. Chairman, let's discuss for a moment a topic that's very important not only to me, but my friends in the majority on the Financial Services Committee. The national unbanked rate has been falling steadily for the past decade, and since the last calculated in 2019 sets at about 5.4%. Still, this represents more than 7 million U.S. households without a checking or savings account. Unfortunately, the COVID-19 pandemic is likely to contribute to an increase in the rate of unbanked households. Chairman, what would you suggest to reduce the adverse impact on the unbanked and underbanked in the aftermath of the pandemic to ensure that no one is left out of the economic recovery?
I think it's a serious problem to address. We tend to address it through our community affairs and efforts to make sure that, fair lending policies and things like that. I also think that there's more that Congress can do, I'm sure, to assure that people have, education around financial matters. And the other piece of it is there are people at the lower end of the income spectrum who are living hand to mouth. We need a strong recovery. We need continued support for monetary policy, and we'll be providing that as well.
Shepard Smith here. Thanks for watching CNBC on YouTube.